Okay, I think we'll see others trickle in, but we want to make sure we give our speaker as much time as possible. So you can see our upcoming programs here. I'm going to go ahead and introduce our speaker today. My name is Debbie Henney. I'm Director of Curriculum for the Foundation for Teaching Economics. And you'll notice Lisa Chang is also here helping us run the program today. Our guest speaker is Danielle Zanzalari. She's an Assistant Professor of Economics at Seton Hall University. She previously worked as Vice President of Credit and Portfolio Risk at Citigroup and as a financial economist at the Federal Reserve Bank of Boston. Her research focuses on bank regulation, and she recently has been featured in The Hill and on NPR Marketplace to discuss bank issues. She also creates a personal financial literacy lessons for teachers around the country to use in their classrooms. And so we are so excited to have Danielle here to talk to us today about what is going on in the banking and finance world. And I'm sure you'll have many great questions for her. So what you'll notice in your Zoom tools is you have the option in Q&A, you can add questions, and Danielle will leave time at the end for some Q&A. So if you have a question that you'd like to ask, please put that in the Q&A section. And then we will have a moderated Q&A at the end of the session. And right now, just for our fun, for interest, if you wouldn't mind in the chat, just tell us all where you're from. And I'm not sure how the settings are, if you can see the chat or just we can, but for our entertainment, we would love to see where you're joining us from. So, and do they have chat, Lisa, in the webinar? If you don't have the chat, then use the Q&A for questions. And we're excited to have you all with us today. If you have questions about any of these programs, you can pop those in there and Lisa can answer those also throughout the program. So I'm going to go ahead and stop sharing my screen and let Danielle take that over.
Thank you for having me here. So I want to make sure that you can see what I have. Okay, perfect. So today's talk, we're going to be talking about banking failures, economic slowdown, and what the future holds. So a little bit about what we're going to be talking about today is what happened with Silicon Valley Bank. This has just happened kind of over about a month ago. What went down? How did it go down? And why did it happen? What was the government's response to Silicon Valley Bank and Signature Bank and in general, the banking industry? And what is the state of the banking community going forward? What should we expect? What are we seeing? There's even been some developments this week. That'll all be included in today's talk, as well as what are like the lingering economic questions that exist still from this banking collapse last month. So first off, I want to start off saying that this current banking environment and this kind of debacle last month, does this look like the 2008-2009 Great Financial Crisis? The short answer is no, it actually doesn't. During the Great Financial Crisis, a lot of big banks were crushed by bad loans. They were making bad loans to people that didn't have income to pay them back. They weren't credit worthy. In other words, the issue last time over 10 plus years ago was a credit risk issue. The credit that banks were giving out was not sound. They were not giving it to borrowers that could pay it back. What happened last month and what's kind of continuing to happen is that banks are struggling with something called interest rate risk. And interest rate risk involves when interest rates change, banks find themselves kind of in trouble. We'll talk about that today. And also what kind of happened with the dissemination of information, especially as it relates to Silicon Valley Bank. So what is interest rate risk? Simple terms is you are stuck at low interest rates when interest rates rise. So you buy a bunch of assets at really low interest rates and interest rates rise and your assets aren't worth as much. So essentially you would have been better off waiting to buy, hoping that interest rates rise, and then you have like a high interest rate. So for example, if you bought a treasury bond about 2 years ago, you might have been paid 1% interest. Today, you could buy a treasury bond for 4% interest. So while if you had that bond that only had 1% interest, you'll still get paid on it, but you're not going to get paid as much as you would if you bought a new bond today at 4% interest. The issue kind of here is that when banks buy these assets, and Silicon Valley Bank is going to be did buy a lot of these assets in 2020 and 2021 at really low interest rates, they really didn't know that interest rates were going to rise. And so it became a problem for them, and we'll discuss that. It's always preferred to have higher interest rate assets. Everybody wants to be paid more. They want to have a higher interest rate return to them. And you want to have something like a 5% asset right now. So if you bought a treasury right now, it's 4 or 5%. That's really good. If interest rates fall, you're still locked into a high interest rate asset. So what really happened with Silicon Valley Bank? So right after COVID happened, deposits rapidly rose. You can remember there was a lot of government programs that existed to help infuse banks with capital. Businesses were very much hurting. They were either not allowed to operate by government rules, or just their business kind of fell because people weren't buying products. So a lot of help came into businesses, and that actually spurred a lot of deposits for banks. So banks saw a lot of deposits, Silicon Valley Bank being one of them. They are located in Silicon Valley. And this bank was mostly geared towards tech companies. So they were giving out lots of loans to businesses, specifically businesses in the tech industry. So you could see here in this graph from 2020 to 2022, there's a really, really big spike. I mean, almost 3-4-fold from the amount of deposits that they had pre-pandemic. One of the conditions that if you were a bank, if you were a tech firm that was banking with Silicon Valley Bank and you wanted a loan, so many tech firms need to borrow money to fund operations before they make any profit. You wanted a loan from Silicon Valley Bank, and they were one of the biggest lenders to tech firms. One of the conditions was that you had to deposit funds with them. So you had to hold your deposits there in the case that you ever wanted a loan from them for your business. Okay. The problem with this is that a lot of the depositors were not very typical. And what that means in the banking industry, they're called retail depositors. So if you look at this graph here, especially in the y-axis, it says estimated retail deposit share of total deposits. Retail deposits refer to everyday people, me, you, just people in general. We're considered retail deposits as opposed to the commercial deposits or business deposits. There's a number of different words for them. So business deposits, businesses tend to have much higher flows of cash in and out compared to everyday people like me or you, or retail, which is we need some transactions to maybe pay our mortgage or car loan or to buy groceries. We don't have large swings in cash. Now, if you look at this graph here on the y-axis and go over to SIVB, that's the stock ticker for Silicon Valley Bank, you can see that the amount of retail deposits, so deposits from everyday people, was under 10%. So most of their deposits came from businesses and not from retail depositors. And now, why is this important? Why does it matter if you have mostly all of your deposits from businesses versus just everyday people? Well, most businesses have deposits $250,000. That means that these deposits are not insured. Previously, the FDIC only insured deposits up to $250,000. So if a bank failed and you had $300,000, you would get $250,000 back. You wouldn't get the full $300,000 back. You lose $50,000. So if a large part of your base is not fully insured by the FDIC, this can cause some issues, because if your bank is not doing well, people are going to start to get worried and pull out their deposits. So you can see here, SIVB has a very, very low retail deposits. One of the strongest banks, if you look at JP Morgan Chase, they're closer to about 50% retail deposits. Now, I know this chart's a little bit hard to see, but if you could focus on kind of what I did down here, SVB Financial Group, if you look at the fourth quarter of 2022, technically they actually only had 2.7% deposits that were under the threshold of $250,000. So again, if you are someone that had more than $250,000 in the bank and you catch wind that there's trouble at this bank, you're going to worry and try to pull out your money because some of that's not secure. Now, for any of us that don't have $250,000 in cash at a bank, there's no need to worry because you're guaranteed to get that back. But if you're a business that had $1 million at the bank, you're going to start to worry. Now, I'm just trying to kind of set the pretense here for why Silicon Valley Bank looked very different. They looked different. Our base is mostly tech firms, but other banks are also very, very diversified in how they actually make money. So most banks will offer credit cards, mortgages, asset-backed securities, whether that's mortgage-backed securities or student loan securities. They offer different kind of products. They buy and sell treasuries. They have investment management. So they have kind of their hands in a number of baskets. And that's going to be important here because that means you're not overexposed to kind of one type of strategy. And a lot of banks, like I said, have even more ways that they invest and focus their business than just one or two. However, Silicon Valley Bank was not like that. Most of the way that the banks made money was loaning to tech firms. So they were trying to give these loans to these startups, right? So, startups are very risky. Everybody has an idea. They want to make it big. Silicon Valley Bank will vet them according to their procedures. But if they make a lot of money, if the company does well, the bank's going to make a lot of money. But many of those firms probably won't end up materializing and go out of business. Another way that they made money is holding treasuries. And because of this, because Silicon Valley Bank had a different strategy, they didn't do mortgages. Remember, mortgages were a big issue in the great financial crisis. Silicon Valley Bank was not doing mortgages. They weren't doing asset-backed securities. They didn't even really have a credit card business. So they approached Congress and asked for looser guidelines. So post 2008, 2009 financial crisis, there was a lot of stress testing regulation that came out that forced banks over a certain size to comply with different capital rules. They have to go through a plan. They have to deal with regulators at the Fed, the FDIC, the OCC in different ways than they previously did before the great financial crisis. SVB being over $100 billion set them off above a certain threshold. So a lot of these regulations only apply to banks that are really big. And it makes sense, right? JP Morgan Chase is $1 trillion bank. They're going to behave differently than the bank down the road that might be $1 billion bank. $1 billion and trillion are very different. However, SVB was $100 billion bank. You're thinking they're the top 30th biggest banks in the country. So they're one of the biggest banks in the country. We still have over 4,000 banks. You're talking about a big bank, top 30 in the country, that approached Congress and said, please, look, we're not the same type of bank. We're not risky. We do something different. We don't want the same type of regulations. So what ended up actually happening in 2008 was that the rule previously, if you were over 50 billion, you were subject to a lot of different rules. In 2018, they moved that to 250 billion. And yes, 250 billion versus 100 billion is a big difference in the way a bank operates, but 100 billion is still big. So after 2018, which is right around like the rise of Silicon Valley Bank as being a very large bank, being a very large lender to tech firms, they had reduced regulation because they lobbied Congress for this. Because again, they were presenting themselves as a very different bank and something that no one's seen before. Okay, so I said that Silicon Valley Bank had kind of two main strategies of where they put their money. So they take in deposits and they're hoping to make money by loaning out to these startups and also investing in treasuries. Treasuries are issued through the federal government, and they're to help pay for our government, to pay for Social Security, roads, schools, whatever the budget needs. Treasuries are the safest asset in the world. And because of that, banks don't have to hold as much capital against them. So after the financial crisis, there was rules put in place in the United States, as well as internationally with the Basel Accords, that forced banks to hold a different amount of capital per risky asset. So for example, if you were investing in government bonds in Venezuela, well, they're going to be pretty much riskier government than investing in government bonds in the United States. And so you have to hold different amounts of money back, because in the case that this asset goes to zero, you know, your whole position doesn't kind of lose. That's kind of the simplest way to put that. And so treasuries are the safest. And that means if they're the safest, you don't have to hold as much capital against them. So that means that you are able to loan out more of your money to these startup tech firms because you're investing in really safe assets. So in general, treasuries are pretty safe, but also if they're safe, it also means that they don't tend to pay the highest amount of interest. And quite simply, banks needed to make money somehow. So if you think post the pandemic, people aren't spending as much money. Some tech firms, they might have been starting up, but people were cautious because people weren't spending as much money. So what a bank did is that they took in deposits from these tech firms and paid them like 0.5% interest, let's say. So they paid them practically nothing in interest, and they bought treasuries with their money. Treasuries, a lot of the treasuries that Silicon Valley Bank invested in were 30-year treasuries at 1.5% interest. So basically, Silicon Valley Bank makes 1.5%. They pay the depositors 0.5%, and at the end of the day, they walk away with 1% premium. Now, if you're talking about billions of dollars, 1% on $1 billion is quite a lot of money. And this is a great strategy if interest rates stay low. But as we all know, interest rates have not stayed low. Okay, what you see here is the federal funds effective rate from the end of 2021 is practically zero. And in 2022, in January, it started to ramp up through now. And we're sitting close to about a 5% Fed funds rate. So again, when SVB was buying these treasuries, interest rates were practically zero. So 1.5 compared to zero. However, 1.5 is not very attractive when other people are offering 4 or 5% today. So kind of how does this actually work with what made SVB collapse? Well, we have to kind of go back a little bit and think about the weeks prior to their collapse. So tech companies are finding it harder to raise money. Why? Interest rates were rising, right? So as we all know, inflation has been quite high. It's been 6 to 8, almost 9% year over the last about year and a half, 2 years. And as such, the Fed was raising interest rates to kind of help cull inflation. Well, when interest rates rise, it's very expensive to borrow money. And again, think of the customer base of Silicon Valley Bank. They're tech firms that need to raise off cash quite often. So they like to borrow. Typically, borrowing from banks tends to be cheaper than going to raise money from venture capitalists or other really wealthy people with cash. So they tend to go to banks to borrow money. But it was becoming very difficult to borrow money because now the money's at 10, 11, 12% premium as opposed to 5%, like in early 2020. So what were tech firms doing? They were saying, okay, look, I'm not going to borrow money, but we have deposits. I'm going to pull it out. I don't want to borrow at a high rate. I'd rather just pull out the cash I already have. And this is not a bad strategy. This is a very typical strategy that businesses do all the time. Businesses were doing this not just at Silicon Valley Bank, but elsewhere. They didn't want to borrow. They pulled out their deposits. However, you have to think of the customer base of SVB. They were all tech firms, so they all need cash. They need a lot of cash quickly. So deposits fell 6.5% really, really quickly. And that's a huge amount of money to come out over the course of a couple of weeks. And the problem is SVB didn't have a lot of cash on hand. So if everybody comes to your bank looking for cash and you don't have cash, you have a problem. You have to sell your assets to get cash and pay the people what's rightfully owed to them. And so SVB said, okay, well, we have to sell our assets because we don't have cash to pay our tech firms. Like they have money in their account. We don't have it sitting here in vaults because banks don't do that. They lend out money to try to make money, and then they pay depositors the difference. So if everybody comes at once looking for their money, you're not going to have it on hand, and you have to actually sell your assets. And if you sell them quickly, they're called fire sales. So SVB was involved in fire sales. Now, what this means is they had to sell their treasuries very, very quick, but at a very huge discount. Why? So if I have a treasury and I'm SVB and I'm like, please buy it. I need this cash. I got to go pay this tech firm over here. Let's just say it's Facebook. Facebook wants their money. I want to pay them. Please buy my treasury. And you're an investor. My treasury bond's only paying you 1.5%. Why would you buy a treasury from me, Silicon Valley Bank, when you could go today and get a new one for 4%? You're not going to do that unless I discount my bond a lot and make it really cheap and really attractive compared to the 4% bond. So very few investors wanted what SVB was selling. And the problem is they needed to sell, they needed cash. At the same time, venture capitalists, so a lot of these other backers of these tech firms, got worried. They see all these bonds listed on exchanges from SVB, because SVB needs cash. They're doing the right thing, trying to sell them. But venture capitalists, which are smart investors, see, wow, SVB is selling a lot of bonds all of a sudden. What's going on? Uh-oh, they might need cash. Uh-oh, are we not going to be able to give our cash out? And so these venture capitalists are saying to their companies, take out your cash now before you're last in line and you can't get your cash. And then because of the dissemination of information and how quick everybody is on social media and online, and Slack specifically, which is kind of a messaging channel for tech companies, is that it led to a bank run. And so what bank runs typically happen is people traditionally in the years past, before everything, would run to the bank, bang on the door, and get in line to try to get their money. And whoever was first would get their money, whoever's last would not get their money. And so you see basically a bank run starting. How bad run? SVB, so Wind got out kind of that Thursday, March 9th. People withdrew $4 billion from their accounts. Remember, this is a $100 billion bank. So you're almost seeing about 40% of all deposits leaving in one day. This is unheard of. It's 4.2 billion an hour, or 1 million per second for 10 hours straight. Just to kind of give you a sense of the amount of cash coming out. This is the most amount of money that has ever come out of a bank, period. And this just happened last month. Previously, the largest bank run was Washington Mutual in 2008. And it was 16.7 billion, and it was over 10 days. So you had 42 billion coming out in one day. It was actually really unheard of. So, all right, so what happens? The government's going to come in and they halted deposits from leaving. They say, well, you can't keep, if 42 billion is already out the door, we have about 58 billion left. Everybody else is going to pile in on Friday. We can't have it. So they actually halted deposits. Said, anybody else who has money, you can't get it. Okay, so obviously people are going to panic. The FDIC shut down the bank that day, that afternoon on Friday. And typically the FDIC doesn't do this. So this really should have signaled trouble. The FDIC typically close a bank after bank hours because they don't want people to panic. They don't want the media storm. They don't want everything that actually happened to happen. They want to close it at 5 p.m. Friday or Saturday and kind of come with a new approach so markets stay very steady instead of crazy. Why do they do that? Like I said, markets aren't open and they want to find a potential buyer. So typically what happens when the FDIC tries to close a bank over the weekend is that they try to find a buyer. Now, the problem is SVB was a $100 billion bank, top 30 in the country. There's very few amount of buyers that can buy a $100 billion bank. You have to be like the biggest in the country. And like I said, SVB had some really bad assets. They had really low paying assets. Why would anybody want to buy them? So they weren't really successful at finding a buyer for a lot of their assets. So they had to close them immediately. So FDIC was on the phone Thursday, Friday morning, calling JP Morgan Chase and Citigroup and Bank of America, these really big banks, said, can you buy this bank? And they were all not interested. Another reason that banks were interested in originally buying Silicon Valley Bank is because during the great financial crisis, when Bank of America bought Countrywide was involved with a lot of mortgages that were kind of fraudulent and not in good practice. Bank of America, they bought Countrywide with the help of the government. The government then sued Bank of America for all the mistakes of Countrywide. So if you are a bank, why would you kind of buy another troubled bank to eventually be sued for this troubled bank's issues? So kind of precedent was already set that if you buy one of these troubled banks, this might lead to future legal actions, and this is not, something desirable for your business. Okay, so what ended up happening? So Sunday night usually announce things Monday morning when markets open. They didn't, they announced it sooner. I'm just trying to give you a sense that this is very urgent. They don't do this. They didn't do this during the great financial crisis. They came out Sunday night and said, okay, look, we're having a systematic risk exception. And they front run this on Sunday, so that way Monday morning people were going to their bank and withdrawing tons of money. What they said is that all bank deposits are insured without limit to prevent any runs at regional banks. So they were hoping that, less diversified depositors, so regional banks that might only be concentrated in, let's say, real estate in South Carolina or real estate in California or manufacturing in California or manufacturing in New Jersey, these banks weren't going to be subject to runs because they were servicing a really small part of the population. They insured all bank deposits. And they wanted to make sure that if you had over $250,000, you weren't moving your money. And there's a lot of people that have over $250,000, especially if you are a big business. So they tried to say, look, don't move your money. Everything's good. We have you completely insured to no limit. Okay. And in doing so, they created a new Silicon Valley Bridge Bank, kind of a technical legal ways to allow depositors to get their money out. So they made sure no depositors lost money at Silicon Valley Bank. Bondholders and equity holders, so all kind of shareholders, lost money. Depositors did not lose money, and senior management was out of a job. They also closed Signature Bank, a separate bank, as a precaution. So Signature Bank looked kind of similar to Silicon Valley Bank, but they had about 25% of their deposits from cryptocurrency, so a little bit different. But similar to Silicon Valley Bank, 90% of their deposits were over that $250,000 FDIC threshold. So they were mostly, working with businesses, law firms, health firms, so forth. They did not have a lot of retail deposits. And Signature Bank also lost about 23% of their deposits on Friday. So basically the writing was on the wall, and the FDIC said, I think Signature Bank's going to go down like Silicon Valley Bank. They have a very undiversified amount of depositors. They have businesses that are going to move their money. This is going to go down the same way. So we're just going to preemptively close this. Again, they created a bridge bank and made depositors whole of Signature Bank. And some of these deposits were bought by another bank, and the FDIC kind of helped with that. Okay, so I'm kind of summing this up here. So kind of what happened Monday. So this is all going down over the weekend. Thursday, 42 billion of deposits go out. You can't get your money out. There's a lot of confusion. No one knows what's going on. By Sunday, the government says, look, we'll insure all deposits. So what actually happens on Monday when markets open? There's massive trade halts. So trading will be stopped. And there's certain circuit breakers that'll stop at 7, 9, 10% falls in stock prices. So bank stocks were falling dramatically, and then you were able to trade for a period of time. Why were they doing this? Well, investors were pricing in new future regulations. So if you're someone that invests in banks, I know I am, you see that, okay, well, this is not good. There's going to be massive regulations coming out that's going to hit all different levels of banks. That's going to make it pricier to do business for banks. At the same time, you might be worried, does your bank have enough liquidity to keep going? Now, I don't have over $250,000 in a bank, so I wasn't particularly worried. But if you had a business that had over $250,000 in cash at a bank, you might have been worried. So stocks were going down rapidly. Specifically, regional banks got crushed. So if you look at bank stock performance, and so this is just a preview of some of these from the Wall Street Journal. First Republic Bank sank 62% initially on that Monday, a record drop. PacWest 21%. You had even Comerica, Zions, and so forth also sinking about 20%. So regional banks were crushed because people realized, wow, they're maybe concentrated only in a certain region with big businesses. They might experience a run on banks. So where does this leave us today? What is the current state of the banking sector? Well, investors were beginning to think that regional banks would be okay. So investors thought that regional banks were going to fare okay because after this announcement and after the little volatility on Monday, things were going well. But First Republic Bank, the bank that dropped 62% originally, has just had a really bad week. I don't know if any of you have been paying attention to the news, kind of what's going on, but a re-emerging kind of bank story is happening this week as well. They just had their Q1 earnings report, First Republic Bank, and in the report, they reported that this quarter alone, deposits fell by 35.5%. Okay, so and about 80% of their deposits would have been considered uninsured previously. So again, they weren't catering to retail people like me and you, your cousin or mom or anything. They are mostly catering to businesses with big deposits. And so a lot of these businesses moved their money because they said, I understand the government's universally insuring deposits, but they're not going to do this forever. And I don't trust this bank. At the same time, loans were up 22%. So they were loaning out more money, but deposits are less. So for capital ratio purposes, you can't do that. You can only loan out a certain amount of deposits. Well, if deposits are falling and you have this many loans out, you have to kind of bridge that a little bit. And so they had to borrow money. They had to borrow a lot more money. And kind of, how do you make sense of all this? Well, First Republic Bank disclosed that their loans on average yielded about 3.73%. So they were making 3.73%, but they had to borrow money from between 3 to 4.9%. So if you're only bringing in 3.73% and you're borrowing at a higher rate, your net interest margin, or kind of the money that you would be making, is either zero or a negative in some cases. So this is not very good for a bank, and not very good for a very, very large bank like First Republic Bank. And so what ends up happening, and First Republic Bank even said this in kind of their announcement, is that they have to cut back on loans. They have too many loans out. And what that actually translates to you and I and the rest of the economy is that there's going to be less available mortgages, business loans, and so forth. And they're a very big bank that does this. They're not the only bank that's going to have to kind of cut back, because as deposits are moving, you have to pull back your loans. Every bank has to do that. So deposits are shifting and people are holding on to more money because they don't trust what's going on in the banking economy or the banking sector. That means less available loans to fund. So essentially what's going on here is that the banking sector might end up leading to borrowing issues. If you look at this graph here, this is from the Federal Reserve economic data out of St. Louis. And this shows non-financial businesses, so non-banks, no one involved in the finance sector, and how much kind of debt or loans that they have. And you can see here, this is about 19 trillion or so at the end of 2022. Kind of circled this in red here. So this is the highest it's ever been. And previously, businesses were borrowing a ton since 2022. They'd been borrowing a ton because interest rates were really, really low. But if the economy slows down and businesses need funds to kind of pay back old funds, they might not be able to get it. If a lot of these businesses are pulling back how much they're loaning to businesses, then businesses are going to have a hard time, especially if there's an economic slowdown. And so the issue that the banking sector has created is not just a loan for Silicon Valley Bank and Signature Bank, closing them and creating uncertainty, but it's also kind of going to force banks to cut back how much lending they do. And that, yes, that involves mortgages to everyday people, but it also involves to businesses who employ people and have other outstanding loans. So this could end up being a big issue for businesses that businesses are going to have to cut back. Other kind of lingering things with the banking community going on is, did the Fed create two different systems going forward? So if you look at the banks by asset size, I mentioned that SVB is the top 30 bank in terms of asset size. They're just over the top 15 banks. So you see JP Morgan Chase has a lot of money in the trillions, but you also see banks that are very, very big. All the banks here are considered very, very big. And what happened right after this, so kind of later that week, right after Silicon Valley Bank went down and the government had to interfere, is that the Treasury Secretary, Janet Yellen, stated deposits would only be covered if the bank creates systemic risk and significant economic and financial consequences. She stated this in response to Congress, in which she was kind of grilled about a number of things. And the senator from Oklahoma mentioned, hey, are Oklahoma regional and small banks safe? If they fail, are you going to guarantee all deposits and all the stuff? And she kind of presented an issue here. She said, well, we're only going to really intervene if there's systemic risk and significant economic risk. Now, maybe a small bank in Oklahoma, I mean, you probably is not going to create massive risk, but SVB, which is a top, 20 bank, Well, they look a lot different than maybe a small rural bank in Oklahoma. So did the Fed create two different systems? And some people are saying yes, right? Big banks are considered systemically important. Excuse me. And that they can't fail. And the government's not going to let them fail. So, pour your money into JP Morgan Chase because they're not going down. Whereas, essentially is it almost saying that your deposits are always going to be guaranteed forever if you're at the biggest banks? Why not go to the very biggest? Not even just kind of big at TD. Go to Bank of America, go to JP. They're the biggest. And the second kind of system would be all these other banks, these small banks. But the government's saying, look, we're not going to step in if they fail. You're only at 250. And so, if you're someone that has a small business and you have over 250, maybe you don't want to bank at these smaller regional banks. I mean, these are the kind of lingering questions that are going on in people's head. What kind of system do we have? And that's why you saw a lot of deposits moving because people weren't sure. And some other lingering questions that kind of have persisted after this economic kind of debacle last month is, there's about 5 of them. I'll go through them and then we'll take some questions at the end. Should you be worried about your money? I'll address this. Was SVB in the banking industry bailed out? So you're talking, is this a bailout or not? I kind of want to lend some insight there. Should we reconsider deposit insurance? If the government's going to step in to insure all deposits, like, do we even need it? Government paying for this. Is this true? Should we believe them? And was there a better solution than what we just saw, that response by the government in the banking sector? I'll take the first question, which is, should you be worried about your money? Simple answer is no. In December 2022, the FDIC had 1.27 times the amount of insured deposits. And so if you had less than $250,000, you should have felt very secure that you would get your money back. If you had more than $250,000, you could always split your money between banks. The FDIC limit is $250 per bank. There's some rules on different accounts, but just say per bank roughly. So you can put 250 in JP Morgan Chase, 250 in TD, 250 in Bank of America, and those all would be insured deposits because they're in different banks. But the problem is insured deposits only represent about 50% of the deposits in the US. So if you have under that 250 threshold in the bank, you should feel really secure. The FDIC kind of insurance fund is, at least part of this, very, very secure. Again, over 250, you might kind of want to move some money around. Was SVB in the banking industry bailed out? Can this be considered a bailout if the CEO, shareholders, and management got fired? So unlike 2008, a condition of these banks failing was that the bank management was fired. If you can recall in 2008 and 2009, a lot of the CEOs of those biggest banks got government funds, and those banks still existed, and the CEOs still stayed in place. What happened here is that the management was fired, shareholders got zero, but depositors were made whole. Depositors are not the bank. They are users or customers of the bank. So this lends to the question, was the bank bailed out, or were users bailed out? Or is this even the same thing? And one kind of follow-up question that people have right now, maybe you have, is does the Fed have a role to keep depositors safe against bad or greedy actors? My take is that the bank really didn't get bailed out because the shareholders, the people that were supposed to be holding management to kind of a higher standard, they got nothing. CEOs got nothing, but depositors got things. Are depositors part of the bank? They're customers, but they're not really the bank. And just something to think about. Should we reconsider whether deposit insurance is helpful if the government steps in to insure all deposits? So deposit insurance was intended for people to specialize, that you don't have to monitor bank risks because you have insurance. So I love banking. I pay attention to this. I invest in banks. This is what I do. I love it, but my husband and other people could care less about banks and don't really keep tabs on what management's doing, what they're investing in, and so forth. And maybe if they are, say, a coffee barista, they own the coffee shop, they're really good at coffee, but they're not really good at banking, you would force that barista to be very knowledgeable about a bank if you didn't have insurance, because they'd have to make sure that management is really good. But once we got insurance, that kind of took it away from the everyday person under $250,000 in cash. That bank management or what they're doing, you will be made whole by the government. You're kind of letting the government supervise the bank, and so you don't have to. So you could specialize on what you're good at, say like making coffee. So after deposit insurance, which happened right after the Great Depression, you can see this very, very visually on this graph, kind of this like pinkish red areas when we had deposit insurance. And you can see that we had a large number of bank failures prior to this period and not so many after. So if we didn't have deposit insurance, do we want our depositors to keep bank management accountable? Is that a criteria that we want to see? That's if you're, thinking that we should reconsider deposit insurance, that's something that you might want to think about. The government says taxpayers aren't paying for this. Should we believe them? So here you can see this graph of the Federal Reserve's balance sheet and how much assets they had. As you can see that they were winding this down. So they were kind of selling off some of their assets, some of their bonds to banks, and pulling in cash from society in 2022. And why is this important? Well, they were trying to back money. So there's less money available to kind of help inflation. But then look at what just happened in March 2023. Boom. The Fed bought a bunch of assets and injected a bunch of money basically into the economy. And so how does this affect taxpayers? You've heard President Biden, you've heard a number of government officials, including Treasury Secretary Janet Yellen, saying, look, taxpayers aren't on the hook. Well, I kind of want to tell you that I don't think that's actually very accurate. So what happened is the Federal Reserve also increased primary credit, which is like a lending facility to banks. And essentially, the Fed is a nonprofit in the sense that any profit the Fed makes, they roll back over to the Treasury. So the Fed, writes checks of billions of dollars to the Treasury all the time. Well, if the Fed has to loan out more money, these checks to the Treasury are smaller. If these checks are smaller to the Treasury, that means this money is not helping to offset some of the spending the government's doing. This in turn hurts taxpayers because we're going to be more in a budget deficit. So I would say that yes, this in fact is affecting taxpayers. The second thing is more money in society as there's more lending from the Federal Reserve going on to banks, money supply goes up, that could lead to more inflation. This can hurt all taxpayers because paying more money for goods and services and housing and so forth is not really not paying for it. It is quite costly for all of us. Lastly, they have not announced this yet, but you better believe there's going to be higher future deposit premiums and less interest paid on deposits. And so if you are a depositor, you're going to get not as much interest on your money. And a lot of depositors are also taxpayers. So I would say that yes, taxpayers are kind of implicitly paying for this if it's not explicit, but they are implicitly, paying for this. So kind of last lingering question here is, was there a better solution to instill confidence in the banking sector? And I want to take this back to classic economic example, and we could kind of debate a number of reasons why it might have been the best response or might not have. And I'm not really sure even kind of how I would think of it. I don't really have the answer here, but I have one way that I would consider this, which is looking at marginal benefit and marginal cost. So the cost of insuring deposits for Silicon Valley Bank was about $20 billion and 2.5 for Signature Bank. So you're looking at about $22.5 billion this just cost us this past month from a government standpoint. And we also universally insured deposits. So technically, we potentially might have a bigger cost, right? If all these banks went down, we had to fund all the deposits. Well, all the deposits equal about $19 trillion. So we could have a lot of cost with what just happened this past month. Now, all the banks didn't go down. That probably would be a disaster of no proportion, but more banks, like I just said, First Republic Bank's not looking too good this week. I don't know if the government's going to step in. I don't think so, but that might add to another cost as well. Now let's compare the benefits here. What is the maintain and help public trust in U.S. banks and the U.S. financial system? If that is the role of the Fed, what is this worth? Because the Fed and FDIC tried to maintain trust by guaranteeing deposits so people didn't panic on Monday and run to their banks. And at the same time, if this is worth a lot, does this mean that they have to guarantee deposits forever? Unlimited deposits, $1 billion, you'll get $1 billion back, you get 250 back, you'll get $1 million back. I don't know. It's hard to kind of quantify the benefit, and it also depends on what kind of role you think the Fed has. So one of the ways to look at this is looking at the cost benefit analysis. Okay, so final thoughts, kind of winners and losers on kind of what happened. And I just like to do this as a little bit of competitive side of me. Certainly the winners here are large banks. So JP Morgan Chase last quarter had record profit. They grew profit 52% year over year, 12 billion in profit in one quarter, 12.6 billion, the most ever. Okay. Citigroup also a tremendous amount of profit, about almost 5 billion in, again, one quarter. So year over year, about 7% better than last year. Remember, we still have inflation. So think about this. This is a record amount of profit. Wells Fargo, 5 billion. And also these banks don't pay a high deposit rate. They pay very low deposit rates because they know they're really big. And what they're offering is, look, we're big. If something happens, I'm pretty sure the government's going to bail us out. And so they don't have to offer really high incentives with interest rates. So large banks seem to have made out here because they collected a lot of deposits when everybody was panicking in March 2023. Also, any firm that has over $250,000 in deposits, I would say, has won here, because if you're a tech firm, now you know, like, hey, all my money is completely safe. I feel really good. I will 100% get all of my money back no matter what, no matter where I bank. Okay, so again, I think these are pretty much the winners here. The losers are probably potential homeowners and mortgage companies. So we have high interest rates, and if banks decide to cut back lending because they're dealing with all these deposit outflows, we should see less mortgages and less lending. So anybody looking to buy a home or any mortgage company is going to be in a worse position. As well as the regional banks. The S&P Regional Bank Select Industry Index, which is just an index that tracks regional bank performance, has fallen 34% in about a month. It's very, very bad. And deposits are down 21%. So deposits in the entire banking system are down 21%. You're looking at about $4 trillion has gotten sucked out of banks. 4 trillion. So that's 4 trillion. The percentage that less potential spending by banks gotten sucked out of the economy in the first quarter. That's mostly through regional small banks. Also, these regional small banks are going to need to pay a higher deposit rate to attract people. And these regional small banks are going to see now tougher regulations post SVB's failure. So you should expect that banks that are 50 billion, maybe even $1 billion higher, are going to see a lot more regulations. Okay, with that being said, that is the end of my talk. So I will take questions here. Okay. Debbie, is there a way that you want me to do this?
Here, I'll go ahead and read you the first one. And if you see a question, if you're in the audience and you see a question you like in the Q&A, you can upvote it and move it more towards the top. So Matt Lind asks, is the deposit requirement for tech companies typical of banks like SVB? Why wouldn't tech companies just deposit the $250K with SVB and spread the rest of their deposits with other banks?
That's a good question, Matt. So if you take a bank like even like Meta or Facebook banked with like Silicon Valley Bank, well, Meta's payroll is probably much more than $250,000 per month. And so it would be very complicated to do HR and payroll if you are a $1 billion company like Meta and Facebook is. So it's not just really small startups. It's actually very well established tech firms. So that's what makes it complicated. And actually, Congress is kind of taking on the idea of maybe businesses have a $5 million limit and so forth. Again, these were conversations. I don't know what kind of traction that's going to have. But if you're a small business with maybe $500,000, I agree. They probably should split up their deposits. But for big firms, that doesn't work well.
And then Tanya asks, do credit unions work the same as banks?
Yes and no. So they have deposit insurance, and they are subject to rules with the national, it's the NCUA, I believe it's National Credit Union Administration or Association, and they're going to run very similar to banks. Credit unions just have different rules. So specifically, they kind of have a rule like SVB, which is if we loan out to you, you got to put your money here. But credit unions also benefit because they are much more localized. They have a lot more local knowledge of the businesses and people that work with them and bank with them. And so in a sense, it's more of a family atmosphere, and they're not as detached from what's going on in their community. And so they can kind of get a better pulse of what's going on economically in the area. So a bunch of businesses are laying off people. The credit union is going to be much more aware of that than JP Morgan Chase, because they bank everywhere and they don't know what's going on in like a small town of Mississippi or Ohio or something, whereas the credit union in that area will.
Thank you. And Lisa said, do you think this failure of SVB has had some impact on why many of the tech companies are laying off employees?
I think that a trend started before, actually, because of the high interest rates. It's really hard to borrow money. So if you are a bank, they call them always pre-revenue. I'm sorry, if you're a tech company, it's pre-revenue, which or pre-profit. You're not making money. You're just sinking a lot of costs in to kind of maybe build up a software product or build up an app or something. Well, if it's harder for you to borrow money or much more expensive, you don't want to borrow as much money. You want to be a lot leaner of an operation. And so I think that's why they're laying off a lot of people. Okay.
And Danielle has a question about the $250 per person. She said at her bank, which is Truist, she said if she has more names on the account, like adding her husband and children, it's increased to $250 per person. And does that sound right?
Yeah, that's correct. So I said $250 because that's just kind of a general rule, but you could have a separate account, a joint account, and they're both covered separately. Those are kind of the nuanced rules, but you are absolutely right there.
I did not know that. I've learned a lot tonight.
Good.
I'm going to be the fun fact at dinner time tonight. I'll say, hey guys, want to know another fun fact I learned? Okay, Raymond says, what do you expect for the Fed to say in its summary report on May 1st? And I'll tie in Raymond's cynical question with that. He says, do you expect the Fed to accept responsibility for falling asleep in its regulatory role? So did they fall asleep? And what do you expect for them to say in their summary report on May 1st?
So I definitely think there's a question of where were the regulators in this. It's kind of twofold, because I was involved in the stress testing process of the Fed, where we go in and we basically, it's like you running on a treadmill and you're at the doctor's office, they test your heart to see, oh, are you good under stress? Well, that's what they do to banks. They say, well, what happens to stocks decline 20%? Everybody loses their job, 20% unemployment. How does your bank fare? That's currently the exercises that I do every year for the biggest banks. And when I was at the Fed, we were still doing it for banks that were 50 billion plus. Well, those rules were relaxed in 2018. So the Fed wasn't, because Congress relaxed them. So the Fed was not getting kind of the same information that they were getting in years prior. So that's the first thing. The second thing, though, from working in bank, I just don't understand how this was particularly missed. Most banks have interest rate risk teams, 20, 30, big banks will have 50 people working on interest rate risk. And what that means is they're trying to figure out, okay, if I lock in all my money at 1.5% for 30 years, what is the risk that the rates go up? Well, I mean, kind of anybody with a very simplistic knowledge of interest rates would say, I think rates are going to go up in 30 years. I would never, as a personal investor, lock in at 1% when 30 years of time. So internal management controls were certainly lacking. I don't know if anybody knows this, but one of the managers that were fired from Signature Bank actually used to work at Lehman Brothers. And he was one of the people that got let go. And he was actually in this fixed income division. Fixed income is literally looking at interest rate risk management. So it's kind of, lots of people dropped the ball. I would say some regulators did. Not just the Fed, the FDIC is a regulator, the OCC is a regulator of big banks as well. So something was amiss there, but also internal management practices were very much amiss. And they're going to have to kind of clarify how that went so wrong and how they got invested in 30-year bonds at 1.5% interest. With the massive amount of money that was coming into the economy in 2020, everybody that was an economist that I knew, I mean, it doesn't have to be an economist, but banker was saying, we're going to get inflation. This is just so much amount of money at once. We're going to get inflation. And when there's inflation, rates rise. It means this is a very simple economics 101 kind of, cause and effect here. So how did the bank not see that? And I think that's going to be really interesting. So what do I think the Fed's going to say? They're not going to admit fault. I do not think they're going to admit fault here. I think they are still going to focus on inflation. And I think they're going to really kind of hone in on Treasury Secretary Janet Yellen's comments about we're going to help out banks with systemic risk, but maybe not everybody.
Yeah, people are definitely going to be listening because it's not just a story about inflation anymore. People want to know about inflation and banks. I know for me, you've cleared up a lot of things and I've learned a lot, and I'm sure our audience feels the same way. So we're very excited that we could have you here to speak to us tonight. And thank you, Danielle. And on behalf of all of our FTE listeners and Ted and Lisa, we thank you for coming tonight. And we hope we can have you back, hopefully for, an update, in brighter times.
To come back. Yeah.
Not worse times.
No, unless they bail out First Republic Bank the next week or do some version of, bailing out depositors. Yeah, no.
Now we know who's listening when this kind of stuff happens. We know what you're doing all weekend long when there's a big story happening. We know Danielle's got her ear to the wire, so we'll know who to call.
Yes, thank you. Thank you for coming. And if you want to interact with me, feel free to reach out on Twitter. It's just D Zanzalari. So happy to have conversations there. I post a lot of bank stuff too. So
okay, you'll get some new followers tonight. Thank you very much. Have a great night, FTE. We'll see you guys in the future.
And one reminder to everyone, I did put a link in the chat for the evaluation. So if you could please fill that out, just take a minute, that'd be great. But thank you again.
Thank you, everyone.